Alright, yo, what is up guys? Welcome back to another video. Alright, in today's video, we're going to be fully breaking down the unicorn model. Now, this is one of the models that I've used in trading to make over 6 figures. And it's also one of the models that just has such a high win rate. And it's very rare that I see this model fail. So please pay close attention. Alright, I'm going to be fully breaking this down, explain this model to you, how you can incorporate it in your trading. I'm going to be giving you a full risk management plan for this model as well later on in the video. First things first, just going to be explaining how this model actually works. And then later on in the video, we're going to be breaking down some live examples in the charts. Alright, so anyways, let's get straight into it. So as you can see here, we have a bearish example, and on this side we have a bullish example. Alright, so let's start off with the bearish example. Okay, what a unicorn model consists of, alright, is a breaker block that is overlapping with an FEG. Now, if one of these P arrays are missing, then this is not a unicorn model. Alright, if we have a breaker block but there's no FEG, that is not a unicorn model. Alright, it has to be both fair value gap and the breaker block. A unicorn model will consist of a short-term high, alright, that is followed by a short-term low, that is followed by another higher high, okay, breaking this short-term high, taking more buy stops, alright, and then followed by a very, very sharp displacement lower, breaking below this short-term low, alright, with a strong closure, and this will leave obviously a breaker block and an imbalance behind in price, which would be your FEG. So a breaker block in this scenario here is going to be the lowest down close candle. Alright, since we are bearish, we're going to be picking out the down close candle, not up close. Alright, whichever one is the lowest is going to be your breaker block. Right, so you're going to mark that out to the right, mark it out as your breaker block. Okay, FEG. Alright, I'm not going to explain what that is because it's a fair value gap. You know, most people that watch my channel and trade ICT concepts, they're going to know what a fair value gap is. Alright, but if you don't already know what an FEG or breaker block is, please head over to ICT's channel, alright, and just go through some of his content, alright, and you'll be able to understand what it is. Anyways, let's go over the bullish example. Alright guys, just a quick announcement. I'm very excited to announce that we have now moved over our subscription plan and payment system over to Whoop. Alright, so anyone currently on a monthly plan that has signed up through Stripe will still be able to keep their subscription on there, but I do highly recommend that you move over to Whoop once the monthly subscription comes to an end, as you can get full access to the A to Z Mastermind course for absolutely free, okay, directly through Whoop. I've decided to stop charging for this course. Alright, so if you buy either the monthly plan or the lifetime access, either subscription will get you access to that course for absolutely free. Now, I go live literally every single morning at New York Open, where you can gain access to the live trading NASDAQ future signals. Okay, you can copy my exact trades, ask me literally any question that you like, and you will receive professional responses. Now, it's very important that you learn from someone who has a proven track record like myself. Okay, I've been trading for over 5 years now. I've literally been through all the ups and downs when it comes to trading. Now, we do have a lot of successful traders inside of our community who are receiving consistent payouts and who also benefit from the accurate and highly profitable signals. We're currently sitting at around an 83% win rate. Now, I'm not claiming that this win rate stays the same all year round, because seasonal tendencies, US elections, stuff like that does affect our win rate. However, the lowest it's ever fluctuated to was around a 70% win rate. But usually we don't go below that. We tend to stay within that 70 to 80% range. So anyways, guys, if you are actually serious about getting your trading to the next level and you are looking for a mentor, all right, you're looking to make money, then I highly recommend that you check out the link in the description. Go secure your spot for only $50 a month. All right, we do also have lifetime access subscriptions available for a one-time payment of $399. So if you don't want to pay monthly, you can just buy a one-time payment and you're in there for life. Anyways, let's get back to the video. All right, so bullish example consists of exactly the same P arrays. Only difference here is followed by a low, okay, followed by a short-term high, which is then followed by another low, taking sell stops which are below this low, right, and then is followed by a higher sharp displacement breaking above this short-term high, okay, having a strong closure, and obviously breaker block is going to be your highest up close candle in this scenario because we are bullish, and your FEG will be left behind in price also. And just a quick little gem for you lot I want to mention, the unicorn model works very good, right, if we're approaching some sort of higher time frame buy side liquidity, such as the 15-minute or the 4-hour, okay, whichever looks the cleanest. If we come up to that buy side liquidity level and we get this type of formation. Obviously, context and narrative do come into play. Don't just be taking these setups as soon as you see them form. Context and narrative behind a trade is what matters the most, because these types of formations and setups happen all the time, but it's very important to pick the ones that will actually work, okay? Because you can pick any single formation like this, which you see on the chart, but without time, price, or narrative, okay, where the market is actually heading, it's not going to matter. The setup will just get ran through and you're going to lose money, okay? So please take that into account. All right, so for a bearish scenario, I usually have my entry just at the edge of the fair value gap, right? And my stop loss is above the swing high. My first EP is usually at some sort of short-term low, okay, around 25 points or more, depending where that short-term low is, okay? And then my second TP and final TP is usually some sort of external sell-side liquidity level, right, which I'm targeting, the draw on liquidity. So let's say here, this is our sell-side level. That is where I'm going to be targeting for price to go. Going to have my long entry off the edge of the value gap, stop loss below the swing low. Now, I know in some cases, guys, you cannot actually set your stop loss below a swing low or swing high, depending the direction you're trading, because you're just risking way too much. So in those cases, make sure to set a fixed stop loss of 25 handles, or don't even take the trade. I sometimes skip trades, right? And I won't even take it because the stop is just not valid. However, in some cases, it is still valid, okay? And you should set your stop loss either below the displacement candles low, okay, if you are going long, or the displacement candles high if you are going short. And usually that will be around 20 handles, okay? That's a typical stop loss for me, okay? But the maximum amount I'm willing to risk is around 25 handles, all right? And of course, take profit is going to be at an external buy side liquidity level, all right? Let's just say we have one up here, all right? This is just for example, demonstration purposes. Now, I know some people ask me as well, when is it that you decide to enter of an FEG? And when is it that you decide to enter off the breaker block? Because these are two different PD arrays, and there are some cases or instances in trading where I'll enter off the breaker block straight away instead of waiting for that fair value gap to form. Now, this comes with experience, so I can't really give you that experience. You need to go into the market and trade for yourself to gain that. But what I can teach you is different scenarios, all right? So whenever price closes very, very sharply below this short-term low here, and I can see that a lot of speed and velocity coming into the market, right? We might not actually get an entry off an FEG because price wants to draw towards that liquidity very, very quickly, all right? Hasn't got any time to waste. So in these cases, as soon as we have a very strong closure, right, I'll literally enter straight away once price retraces to that breaker block. And obviously have my stop in place. As long as it's 25 handles or less, that's a valid stop loss for me. And I'll take that trade, all right? If we get a low to medium candle closure below this short-term low, right, and there's not as much speed and velocity as there was in the previous example, then I'll wait for that FEG to form and I will enter off of the fair value gap. Hopefully this makes sense. Obviously there's a lot more that goes into it, but like I said before, I cannot give you my experience. That's just something you need to gain when trading, all right? So the more you trade, the more you go into the market, the more you will learn and gain experience, all right? All right, so now that we've gone over pretty much the basics and the theory of how this model actually works, the next slide we're going to be talking about time and price, okay? Which sessions you should trade this model in, and what time exactly you should be entering your trades, right? Because without time, like I said before, this model is completely useless and it's not going to work for you. You need to incorporate time within your trading, all right? That will help you a ton. And we're also going to be going over some risk management parameters for this model, all right? Let's get straight into it. All right, so I only trade a New York session. Now, I know people trade London and Asia. That's totally fine as well. However, it's just not for me, and I haven't really tested the model in those types of sessions, so I won't be able to speak on it and let you know how it works during that specific time. All right, but for the New York session, I know exactly how this model works. Okay, I've back tested and forward tested it, so I can tell you with confidence that it does work very well inside the session. Now, the times I trade are from 9:30 a.m. New York time, which is when the market opens. All right, I don't take any trades pre-market. I know the New York session starts before 9:30. However, I just don't tend to trade before the actual market opens. Okay, it's lower probability. So the times you want to be trading are from 9:30 a.m. New York time to 12 o'clock New York time. All right, 12 o'clock is when lunch hour begins. You don't want to be taking any trades after that. But anyways, these are the two specific macro or time windows that you actually want to be entering your trade. And this is when you also want to be looking for that unicorn model to form inside of these time windows. Anything outside is going to be lower probability, and I wouldn't really advise taking it. Okay, so we have two macros that I trade. All right, so first one is 9:50 to 10:10 macro, and the second one is 10:50 to 11:10 macro. These are the two specific macro or time windows that ICT have given us. In my actual backtesting and forward testing, I have found that the macro windows are a lot more accurate if you add around 5 minutes before and 5 minutes after. So instead of 9:50, it will be 9:45, and instead of 10:10, it will be 10:15. Okay, so it's now a 30-minute interval instead of a 20-minute interval. Now, I've had a lot of people in the comments telling me this guy doesn't know what he's talking about. He's getting the macro windows wrong. The macro is 9:50, 10:10. It's not 9:45, 10:15. I totally understand that, okay? That is still known as the macro. However, this is only what ICT has given us, and he didn't actually go into depth and specifics when it comes to the macros. So if you want to be more accurate, these are the time windows that I would advise and suggest that you use. Okay, they work very well, and that is exactly what I use, and it works perfectly for me. So just to make things clear one more time, all right, mark these times out on your chart, 9:45 to 10:15. Okay, this is the window that you're going to look for your entry. Okay, once you get your entry, you can hold your trade past this window. It doesn't matter. As long as your entry is inside of the 30-minute time window or the macro, you're fine. Okay, and you can hold that trade up until 12 o'clock maximum New York time. You don't want to be holding any trades going into lunch hour. Okay, so now that I've given you the times you're going to be trading this model, the last and final part is obviously the risk management plan. So let's go over that. All right, so I've created a full risk management plan here for two scenarios. All right, so if you're going with Apex, usually I recommend that you go with the 50K account because it's just one of the easiest accounts to pass. Okay, very, very simple. Your drawdown is $2,500. Okay, and your target is 3,000. So pretty much a one-to-one when it comes to risk reward. However, with TopStep, I recommend you go with the larger account, okay, because you can't trade as many contracts on TopStep as you can with Apex. So the target for that TopStep account is around 9 grand, and the drawdown is 4.5 grand. So you see there's a difference there. It's a 1-to-2 risk reward instead of Apex. It's pretty much a 1-to-1. So that TopStep is going to be a little bit harder to pass, okay, but I guess once you do pass, you'll have a larger account to trade. Okay, now with Apex, I recommend you start off trading 10 micros, okay, then you close half your position at TP1, you close a further 30% at TP2, and then you close the final 20% of your remaining position at your final TP. With TopStep, I recommend you trade 15 micros, close 10 at TP1, close 3 at TP2, and close the final 2 at final take profit. Now, let's say you take a loss. I want you to half your position size. If you're trading 10 micros with Apex, go down to 5 and stay at 5 until you have your next win. Now, with TopStep, 150K account, you're going to half it twice. All right, so if you take a loss with 15 micros, you're going to go down to 10. If you take a loss with 10 micros, you're going to go down to 5. All right, you're going to stay at 5 until you get your next win. Then you go back up to 10, you go back up to 15. So those are the two risk management plans for either Apex or TopStep. I advise that you go for the 50K Apex. Okay, it's a lot cheaper to start off with. They're always running, 80%, 90% discounts. So that's what I would advise. However, TopStep has less rules, it's less strict, and it's much more easier to get paid out. I know the payout process with Apex is a bit tricky. Okay, they have a 30% consistency rule on the funded accounts. So your profit in one day cannot be more than 30% of your total profits inside the account, which means if you have a large day, you might have to get that winning day down by pretty much just trading more. But if you follow the rules, you will get paid out. So I'm gonna leave that to you guys, which prop firm to go with. I don't have any affiliate links for these prop firms, but I will leave some links down in the description for you to go check them out. All right, but anyways, now that we've gone over the risk management, how to manage your position when taking partials, we've gone over the basics and the theory of the unicorn model, setting stop losses, TPs, etc. What times to trade this model in. All right, we've covered all of that. So now we're gonna be going into the charts. All right, I'm gonna be going over some live unicorn model examples. All right, so you guys can actually see me put this strategy into play. Let's get straight into it. All right, guys, so let's start off with a bullish example. As you can see here, okay, this is inside of that 9:45 to 10:15 macro that we were speaking about. We have our low followed by a high followed by another lower low, okay, taking out this initial low. All the sell stops resting below here. That move is followed by a sharp displacement higher, okay, displacing through that short-term high here. Okay, we have our breaker block, FEG, and of course this is the highest up close candle, so that's gonna be our breaker block. All right, and of course your fair value gap is gonna be this gap here. All right, so you can decide to enter either off of the breaker block or the FEG, totally up to you. All right, so let's say we decide to enter off the FEG. Okay, let's see if we can put a stop loss below the swing low. It's sitting around 30 handles. So in that case, we're not going to be setting our stops there. All right, the next place you'd be able to set your stops is either the displacement candles low, right? But however, there's a FEG here which you need to cover, so I'll put my stop just below, right, that candle's low there, right, risking around 26 handles. So usually I don't like to risk more than 25. In some cases, I will risk a little bit more. Like NFP weeks, the candles tend to be a little bit larger, so we'll have some wiggle room there. And then of course, target some sort of buy side liquidity level pull, right, to the left of us on a higher time frame. And as you can see, that worked out very beautifully. So now that you've seen a bullish example, right, I'm going to be taking you over a bearish example. Obviously, mark out your drawn liquidity here, so this sell side level, and straight away, as you can see, okay, we've swept this buy side liquidity level here. This level has been taken out. All right, so price is coming towards a higher time frame liquidity level, right, which it then starts to form this formation. All right, so you have your high, low, higher high displacement. In this scenario, your breaker lock is going to be these two down close consecutive candles. All right, they are the lowest. Now if you want to be more specific, you can just mark out the lowest down close candle, all right, and use that as your breaker block. Now because they are consecutive candles, technically both of these candles would be your full breaker block. If you want to be really specific, then you can just mark out the last lowest down close candle. And of course your fair value gap, which is here, set your entry at the edge of the fair value gap. All right, stop loss at the swing high because we're only risking 18 handles here, so that is inside of our risk perimeters. And then obviously target the opposing liquidity, which is sell side liquidity down here. So yeah, let's see how this trade plays out. All right, and there you have it, target has been hit. Now of course these are not the best examples because these are not inside of that macro window. Bearish example isn't cherry picked, so it's not the best example. That's why price has been so choppy here. However, if I were to find a trade inside that macro, it would not look like this. Okay, it would look way cleaner and price would just accelerate towards take profit. I don't like cherry picking examples because I get a lot of people in the comments saying, you know, this guy's just showing you replay, cherry picked examples, this, that. So that's why I've just picked out a random example. But as you can see, this strategy does work, okay, even outside of them time windows. Now, do I recommend you trade outside those windows? Absolutely not, because price will look like this, very, very choppy and low probability. Please stick to those time windows that I provided you in today's video. Now, this is pretty much going to be the end of today's video. All right, I hope that you enjoyed it. I hope you got some sort of value out of it. Okay, please leave your suggestions in the comment section below. Please leave a like, all right, leave a comment, share and subscribe, and I'll see you lot in the next one. Take it easy.